Let me ask you something. If I told you that right now, at this exact price of 0.7223, the Australian dollar is sitting inside a structure that has trapped more retail traders than any other pattern this month, would you still be confident about your direction? Because that is precisely what I am seeing across the daily, the 4-hour, and the 60-minute charts. Good morning traders, I am Eric from Alpha Market Meridian. We have a textbook compression zone that is about to resolve, and the data is telling me that most traders are positioned on the wrong side of it. There is one danger zone and one hidden opportunity today. I am going to show you both. Stay until the end because I am giving out 3 exact entry and exit levels you can use right now, complete with stop losses and risk-reward ratios that actually make mathematical sense for your account. Here is what makes today different. The 24-hour news cycle is flooded with headlines about Australian dollar to US dollar forecasts aligning for a breakout on US dollar weakness and risk appetite recovery. But here is what the headlines are not telling you. The positioning data shows institutional traders have been fading every rally attempt above 0.7250 for the past 2 weeks. So either the crowd is right this time and the breakout is real, or the smart money is about to feast on retail optimism. By the end of this breakdown, you will know exactly which scenario is playing out and exactly where to place your orders. Write this down. The number that changes everything today is 0.7166. If we break and close below that level, the entire bullish structure is invalidated and we are looking at a fast move towards 0.7100. But if we hold above 0.7188 and push through 0.7290 with conviction, we are entering a momentum expansion that could run 150 pips before anyone has time to react. So let me give you the instant market verdict before we dive into the technical deep dive. The session bias for Australian dollar to US dollar right now is range-bound with an upside resolution lean. That means I am expecting continued oscillation between 0.7188 and 0.7290 for the immediate session, but the structural pressure is building to the top side. The 5-hour trend confirms this choppy behavior. We are seeing lower highs holding and higher lows defending, creating a tightening coil that mathematically must break within the next 2 to 3 sessions. The daily trend remains technically bullish, with price holding above the 60-day moving average and the 20-day average curling upward underneath current price. But here is the qualification. Being bullish in this structure does not mean blindly buying at market. It means identifying the specific trigger levels where bullish probability shifts above 60% and waiting for confirmation before committing capital. The invalidation level that proves this bias wrong is exactly 0.7166 on a daily close. That is the swing low from the previous structure, and a break below that number signals that the dollar strength narrative is overwhelming the commodity currency bid. If 0.7166 breaks, flip the bias to bearish immediately and target 0.7100, then 0.7050. Do not rationalize. Do not hope. If that level breaks, the market is telling you something and you need to listen. Write this number down. 0.7166. If we break that today, the whole structure shifts. Now let me show you exactly why these levels matter by walking through the charts from top to bottom. Coming to technical deep dive. Weekly structure. Let us start on the weekly time frame because this is where the macro story lives and breathing. Pull up your charts. The Australian dollar to US dollar weekly chart is showing us a recovery pattern that began roughly 6 weeks ago, bouncing from the 0.7000 psychological zone and marching steadily higher. But look closely at the candlestick structure. The past 3 weekly candles have stalled right at the 200-week moving average. The 200-week moving average is sitting at 0.7285, and this is not a coincidence. That level has acted as a brick wall for 3 consecutive weeks. Buyers have tried 3 times to push through, and 3 times they have been rejected. That creates what I call a triple tap resistance zone, and the 4th test is always the most dangerous because it is either going to be the breakout or the exhaustion failure. The moving averages on the weekly chart are starting to tell an interesting story. The 20-week moving average has flattened and is beginning to curl upward from 0.7120. The 60-week moving average remains sloping lower, currently at 0.7450, which means we are still in a longer-term downtrend channel, but the short-term momentum is trying to reverse that trend. This is what I call a trend conflict zone. The weekly MACD crossed bullish 3 weeks ago and has been printing green histogram bars since then, but the slope of the histogram is flattening. That flattening suggests momentum is stalling, not accelerating. This is not a bearish signal, but it is a warning that the move is losing steam and needs a fresh catalyst to continue. The support and resistance levels on the weekly are crystal clear. Support is anchored at 0.7188, which represents the breakout level from the consolidation range 3 weeks ago. Resistance is the triple tap zone at 0.7290 to 0.7319, with the 200-week moving average sitting in the middle of that zone at 0.7285. Above 0.7319, the next resistance is not until 0.7450, which is the 60-week moving average and the previous structural high from early in the cycle. That gap between 0.7319 and 0.7450 is what I call the open air zone. If we break through the triple tap resistance, there is very little standing in the way of a fast 130 pip move. That is the opportunity. That is why I am paying attention. We also need to focus on daily chart breakdown, which now stepping down to the daily time frame, and this is where the setup gets actionable. The daily chart shows Australian dollar to US dollar trading above the 20-day moving average at 0.7195, above the 60-day moving average at 0.7140, and now testing the 200-day moving average at 0.7280. Notice the alignment. The 200-day average on the daily chart basically lines up with the 200-week average I just mentioned. When you get multiple time frame confluences like that, the level becomes magnetic. Price will either reject hard at the magnet or blast through it, and the magnet becomes a trampoline on the retest. The daily MACD is in positive territory with the signal line above the histogram baseline, but here is the detail most traders miss. If you look at the histogram bars over the last 5 sessions, they are shrinking. The signal line is still pointing higher, but the histogram is diverging negatively against the price action. Price has been making incremental higher highs, but the momentum histogram is making lower highs. In plain terms, this means buyers are exhausted. The last 3 days of green candles are showing smaller bodies, indicating that each push higher is being met with more selling pressure. The negative divergence on the daily MACD is not a sell signal by itself. Divergences can persist and even deepen before they resolve. But it is a warning that the bullish case needs confirmation soon, or the momentum failure will cascade down into the 4-hour and hourly charts. The daily support and resistance numbers I want you to mark on your charts right now are these. Support is 0.7188, which is the breakout retest level and the 20-day moving average zone. Below that, 0.7166 is the structural swing low and the line in the sand for the daily bullish structure. Resistance is 0.7290, which is the recent high and the top of the compression range, and above that 0.7319, which is the previous swing high from 2 months ago and corresponds with the upper boundary of the weekly resistance zone. Now here is the cross-asset linkage that confirms the daily picture. I want you to pull up the S&P 500 futures alongside your Australian dollar to US dollar chart. The Australian dollar is the China proxy and the risk barometer. When the S&P 500 rallies, the Aussie tends to follow with about a 0.7 correlation over the last 90 days. Right now, the S&P 500 is also compressing near all-time highs, with gamma levels starting to build above 5,300. If the S&P breaks higher, that risk appetite wave will drag Australian dollar to US dollar through 0.7290 almost mechanically. If the S&P rejects and sells off, the Aussie will likely break support. This is the confirmation signal you need to watch across asset classes. Do not trade Australian dollar to US dollar in isolation. The S&P 500 is your leading indicator for the risk proxy trade, but 4-hour and 60-minute precision IS the CEDA OF today's trading. Now let me zoom into the 4-hour chart because this is where the execution precision lives. The 4-hour chart is showing a textbook compression triangle that has been building for about 8 sessions. Price is oscillating between higher lows and a flat resistance ceiling. The higher lows are at 0.7166, 0.7188, and this week at 0.7205. Each dip is being bought at a higher level. That shows accumulation. That shows that buyers are willing to step in earlier each time. The resistance ceiling at 0.7290 has been tested 4 times now, and each test has been rejected within a 10 pip range. That shows distribution. That shows sellers are defending the level with conviction. The moving averages on the 4-hour are in a bullish alignment but flattening out. The 20-period moving average is at 0.7215 and basically flat. The 60-period moving average is at 0.7198 and sloping gently upward. The 200-period moving average is at 0.7155 and has been acting as the deeper floor for the entire compression structure. As long as the 200-period on the 4-hour holds, the 4-hour structure remains bullish by definition. If that 200-period average breaks, we are falling out of the compression channel entirely. The 4-hour MACD is where it gets really interesting and a bit concerning. We have a clear negative divergence pattern. Price made a higher high near 0.7270 on the last push, but the MACD histogram made a lower high. Then price pushed again to the 0.7285 area, and the histogram printed an even lower high. This is a classic momentum exhaustion signal on the 4-hour time frame. But again, negative divergence in a compression range is normal. It happens when the price is coiling. The divergence only matters if it triggers, and the trigger is a break of the rising trendline support at 0.7205. If that breaks, the divergence is activating and we are going to test 0.7188 quickly on the 60-minute chart. I am seeing a microrange developing between 0.7210 and 0.7235 over the last 6 hours. This is the Asian session consolidation zone. The 60-minute MACD is flat and hovering near the zero line, which confirms the indecision and the waiting game. The 20-period moving average on the 60-minute is at 0.7220, basically the current price. This is a scalper's market right now, not a trend trader's market. And that is okay. Recognizing the environment is half the battle. Let me connect the last 24 hours of news flow to the price action, because this is where the narrative becomes the trade. The core headline driving the Australian dollar right now is the alignment of risk appetite recovery and US dollar softness. The forecast calling for an Australian dollar to US dollar breakout is rooted in 2 separate but converging forces. On the dollar side, the market is pricing in a more dovish Federal Reserve trajectory after the recent data showed some softening in labor market indicators and a slight deceleration in services sector activity. Dollar bulls are losing conviction, and that is opening the door for commodity currencies to run dot on the Australian side. The China proxy narrative is kicking back into gear. The Chinese credit impulse data has shown marginal improvement. Iron ore futures have stabilized above the key $100 per ton psychological level, and there is renewed speculation about targeted stimulus. Measures from Beijing aimed at stabilizing the property sector. Australia exports roughly 80% of its iron ore to China, so the Aussie dollar moves with Chinese demand expectations. Right now, those expectations are cautiously optimistic, and that is feeding into the buying pressure we are seeing on dips. But here is where I want to weave in the cross-asset narrative that most traders are completely missing. When I look at the Australian dollar to US dollar versus the euro and the British pound, I see a fascinating fracture developing. The euro is struggling with its own internal growth concerns and ECB policy uncertainty. The pound is benefiting from Bank of England hawkishness but faces its own fiscal sustainability questions. The Aussie, by contrast, is the cleaner risk proxy play right now because it is not entangled in the transatlantic policy divergence drama. If you want to express a dollar weakness view, the Aussie is arguably the cleaner vehicle than the euro or the pound right now precisely because it is less crowded and less headline sensitive to European politics. Now let me cross-check this against gold and oil because the commodity linkage is essential for the Australian dollar thesis. Gold is trading with a bid, holding above the key support zone, and that tells me the inflation hedge demand and geopolitical premium are still in the market. If gold were breaking down, I would be skeptical of the Aussie rally because it would signal real yields are crushing the commodity. Complex. But gold is holding, and that supports the commodity currency basket. Oil, the geopolitical heartbeat of the market, is also stabilizing. WTI crude is threatening to break above $80 a barrel, and that energy stability feeds through to the broader commodity complex, which in turn supports the Australian dollar as a resource export currency. Here is the 1 to 2 week directional lean and the exact event that would invalidate it. My lean is cautiously bullish with a target of 0.7400 to 0.7450 if and only if the 0.7290 to 0.7319 resistance zone is broken and converted to support. The invalidation of this thesis comes in two forms. First, a daily close below 0.7166 kills the bullish structure outright. Second, if the S&P 500 breaks its own support and starts a risk-off cascade, the Aussie correlation will drag it down regardless of the domestic fundamentals. Watch the S&P. If the S&P breaks, close your Aussie longs immediately. The exact event on the calendar that could flip this is the next Australian employment data print. If the labour market shows unexpected weakness, the Reserve Bank of Australia rate expectations will shift, and the rate differential argument for the Aussie will weaken significantly. Now come to trade setups introduction. Most people will skip this section, but this is where money is made. Keep watching. I am about to give you 3 specific trade plans with exact entry triggers, exact stops, exact targets, and the risk-reward math that justifies each one. Do not be the person who watches the analysis and then places a random market order with no plan. That is how accounts bleed. This is how professionals approach the market. Let us start with the conservative approach. Strategy 1. The sniper, conservative. Strategy 1 is the sniper, and this is for traders who want confirmation before they commit capital. The trigger condition is a 1-hour candle close above 0.7290 with volume confirmation. I do not want a wick above 0.7290 that gets rejected. I want a body close above that level that shows real buying conviction. Once that candle closes, you wait for the retest. The retest should hold 0.7290 as support for at least 15 minutes without breaking back below. That is your entry confirmation. The exact entry zone is between 0.7290 and 0.7295 on the retest. The stop loss goes at 0.7255, which is below the breakout level and below the intraday consolidation zone that will likely form after the breakout. That is a 35 to 40 pip stop depending on your exact entry. The logic behind placing the stop at 0.7255 is that if the breakout was genuine, the market should not come back below the consolidation cluster without invalidating the momentum. A break back below 0.7255 means the breakout has failed and you want to be out with a small loss. Target 1 is 0.7345. Which is the next intraday resistance cluster and represents a 55 pip gain from your entry. That gives you a risk-reward ratio of approximately 1.4 to 1 on. The first target alone. Target 2 is 0.7400, which is the psychological level and the next structural resistance zone. That is a 110 pip gain and a risk-reward ratio of roughly 3 to 1. You scale out 50% of the position at target 1 and let the rest run to target 2 with the stop move to break even after target 1 is hit. What voids this setup entirely is a false breakout where price clears 0.7290 briefly but then reverses and closes below 0.7270 on the hourly candle. If you see that pattern, do not re-enter. The false breakout signals that the resistance is absorbing all the buying pressure and the sellers are still in control. Step back and wait for the next setup. Discipline is what separates the profitable traders from the gamblers. Then strategy 2. The active trader, a standard method to do set up the trade today. Strategy 2 is the active trader, and this is for those who want to participate in the range while waiting for the breakout and are comfortable with mean reversion logic. The entry condition here is a bounce from the 0.7188 support zone with a bullish confirmation candle on the 4-hour chart. Specifically, I want to see price approach 0.7188, form a bullish rejection wick or a hammer candlestick pattern on the 4-hour, and then push back above 0.7205 with momentum. The actual entry would be at 0.7210 after the confirmation candle closes. The stop loss goes at 0.7160, which is 6 pips below the structural invalidation level of 0.7166. I am giving it a small buffer because stops clustered exactly at the structural level get hunted. Placing the stop at 0.7160 protects you from a stop hunt while still respecting the invalidation logic. If the market trades below 0.7160, the support has failed and you do not want to belong. That is a 50 pip stop. Target 1 is 0.7265, which is the midpoint of the compression range and a level where short-term sellers have been active over the past week. That is a 55 pip gain and roughly a 1.1 to 1 risk-reward ratio. Target 2 is 0.7290, which is the top of the range and the breakout trigger level. That is a 80 pip gain and a risk-reward ratio of about 1.6 to 1. The trailing stop rule is activated once target 1 is hit. Move your stop to 0.7195, which is just above your entry and below the session low that confirmed the bounce. This locks in a small gain at minimum and allows the trade to run to target 2 without risking a full reversal into a loss. The condition that voids this setup is simple. If price slices through 0.7188 without forming any bullish reversal structure, do not buy the dip. A clean break lower means the range is breaking to the downside and your mean reversion logic is invalid. Let the market prove support before you commit. Now here is the interaction breaker. Let us see how aligned we are as a trading community. Type your Australian dollar to US dollar range for tomorrow in the comments now. Where do you see the high and the low? I am reading every single comment and I want to see. If the crowd is seeing the same compression I am, or if there is a blind spot I have not identified. Your comment helps everyone watching because it reveals whether the retail consensus is bullish or bearish heading into the next session. And strategy 3. The aggressor with high risk. Strategy 3 is the aggressor, and this is only for those who know how to lose small and manage risk aggressively. This is a high-risk counter-trend fade play that bets on the resistance at 0.7290 holding for one more rejection before the eventual breakout. The entry condition is a wick rejection at 0.7290 on the 30-minute chart with a bearish engulfing or shooting star candlestick pattern. The entry is at 0.7280 after the rejection candle closes. You are selling into resistance, betting that the compression pattern holds for one more cycle. The stop loss is at 0.7315, which is above the 0.7319 structural level and gives the trade 35 pips of breathing room. If 0.7290 is going to reject, it should not trade above 0.7319 at all. A move above that level means the resistance has failed and the breakout is happening. Accept the loss and move on. Target 1 is 0.7230. which is the midpoint of the range and a conservative 50 pip profit. Target 2 is 0.7195, just above the support zone, for an 85 pip profit. The risk-reward ratio is approximately 2.4 to 1 if target 2 is reached. But let me be explicit about the warning here. This is a counter-trend trade against the daily bullish structure. You are fading a trend that is technically still intact. This trade has a lower probability of success than the first two strategies. Only take this if you understand that you are betting against the primary structure and are comfortable with a higher likelihood of being stopped out. If you are a newer trader, ignore this strategy entirely and focus on the sniper and the active trader setups. Before I close this out, let me give you the macro cross-asset context that ties everything together. The Australian dollar to US dollar is not trading in isolation. It is the China proxy, the risk barometer, and the commodity currency all wrapped into one instrument. When I look at the US dollar index, it is sitting right at a critical support level, and that directly impacts whether the Aussie can break higher. If the dollar index breaks below its own support, the path is clear for Australian dollar to US dollar to run. If the dollar index bounces, the Aussie breakout attempt will fail. The S&P 500 correlation is running at 0.7 over the last 90 days as I mentioned, but watch for divergence. If the S&P breaks to new highs and the Aussie cannot follow through 0.7290, that is a major red flag. It means the risk appetite bid is not translating to the currency market, and something is wrong under the surface. Similarly, watch the Nikkei 225 and the US dollar to Japanese yen. If dollar-yen is rallying on risk appetite, that should be supportive for the Aussie as part of the broader risk-on complex. If dollar-yen is selling off on risk aversion while the Aussie tries to rally, the divergence will eventually resolve, and usually not in favor of the Aussie. The gold and oil crosscheck I mentioned earlier is your inflation versus real yield pulse. If gold holds bid and oil stabilizes, the commodity complex is sending a supportive signal for the Australian dollar. If either of those breaks down, the fundamental thesis for the Aussie weakens accordingly. Let me summarize the most critical level for the next session because this is what you need to stare at when you open your charts tomorrow. The level is 0.7290. That is everything. Above 0.7290 with a body close and a successful retest, we are targeting 0.7345 then 0.7400. Below 0.7290 with another rejection, we remain in the compression range between 0.7188 and 0.7290, and the active trader setup is the play. Below 0.7166 on a daily close, the whole bullish structure is dead and we are targeting 0.7100. 3 scenarios, 3 clear levels, no ambiguity. Tomorrow I will be tracking the Asian session reaction to any overnight S&P 500 movements and specifically watching whether the Chinese equity market opens with strength or weakness. That is the immediate catalyst for the Aussie. If we get a strong Chinese open, the compression could break during the Asian session, which would be early relative to the typical New York session breakout pattern. If you want the full breakdown on Bitcoin and the S&P 500 divergence, that video is live now. Check the end screen and click through. The Bitcoin setup right now is absolutely critical because the risk-asset correlation with equities is showing signs of decoupling, and if that spreads to the currency market, the Aussie trade could get complicated. You need to see that analysis before you commit to this one. Smash the like button if this analysis gave you a clear and actionable plan. That is the only metric that tells me I am doing my job. Subscribe and hit the bell for daily coverage on all 8 key assets. Every single session, before the volatility hits, I am here breaking down the levels, the narratives, and the exact trade setups. I will see you in the next one.